We're familiar with the concept when a business needs a capital asset. The business normally goes out and purchases that from a vendor who sells or builds those type of capital assets. However, there are situations where a company, an entity itself, has the resources and wherewithal to actually self-construct some of its assets. And this can happen especially where the capital assets may be highly specialized and require certain engineering activities that are unique and can only be provided by that entity. Typically, when we're constructing a capital asset, there are three major inputs that are typically capitalized within the asset. That includes the cost of direct materials, that includes our direct labor and overhead, company overhead associated with the construction of the asset. Also, and this is where we're going to spend most of our time in this presentation, basically a capital asset can also include interest costs that are associated with internally constructed assets. Typically, interest is a period expense under generally accepted accounting principles, but under this condition, we can actually capitalize all or a portion of the interest costs associated with self-constructed assets. Now, in order to capitalize interest, the asset itself must be called a qualifying asset. And here's the qualifying criteria. Okay, first of all, it has to be an asset that is constructed or produced by the entity for its own use. In other words, we're not out constructing a major or a capital asset for another customer of which we're going to make a profit. The accounting rules are different based upon that. Okay, also, the next qualifying criteria is that we can pay other parties, like a construction company, to construct at least part of that asset on our behalf. So assets that are constructed or produced by third parties for which deposits and progress payments have been made are also a qualifying asset. Okay, also assets that are constructed or produced for sale or lease as separate projects, such as real estate or vessels, as opposed to inventory. Now, non-qualifying assets would include, as I just mentioned, inventories produced in large quantities on a repetitive basis. Again, the rules for accounting for a capital asset for interest cost are entirely different than the interest costs associated with acquiring inventories. Okay, another non-qualifying asset is an asset that is already in use or it's ready for use for its intended activity. Now, that doesn't mean that it couldn't be a qualifying asset up to that point in time, but once it's at that point, it's no longer qualifying for the capitalization of interest cost. Also, assets that we could self-construct that are not being used in earning activities that are not undergoing the activities to ready them for use. Now we need to talk about the capitalization period. And when I speak of capitalization period, what I mean is it's the time required to carry out the activities necessary to bring a qualifying asset to the condition and location necessary for its intended use. So that's what the capitalization period is. In other words, it's not forever, it's for a certain time. Now, I'm going to repeat this essentially in this comment box that I just provided to you. I'm going to repeat this in the rules over here. Okay, capitalization period includes when expenditures for the construction of a qualifying asset are still being made. In other words, we're still paying for it. Activities necessary to make the asset ready for its intended use are still in progress. In other words, it's not being used, essentially. Lastly, interest cost is actually being incurred. Okay, and lastly again, it ends when the asset is substantially complete and it's ready for its intended use. Also, if substantially all asset-related activities are suspended, meaning that for whatever reason we stop self-constructing the asset, so does its capitalization period. Okay, now we're going to talk about how we calculate the interest cost and certain limitation to self-constructed assets. Now, when we're looking at interest costs, we have to define what that is. And an interest cost includes interest on our obligation, our debt, with an explicit interest rate, and that's adjusted for, or it includes the amortization of either a discount or premium on the debt. So our interest cost includes not only the interest rate, but the interest rate adjusted for the either the premium or the discount on the debt. Also, there's another area that we don't want to have cause confusion. In many accounting books, including finance books, a lot of times in order to do a financial analysis, we not only talk about the cost of, cost of debt, but we talk about the cost of capital. Now, in this case, any imputed cost of equity capital is not recognized. So any type of cost of capital, and typically that's some type of interest rate or some type of rate of return that shareholders demand. That's what we call, that's the cost of capital. That type of calculation is not recognized, nor is it capitalized in the self-constructed asset. Now again, the interest paid during the period can be included in the cost of the self-constructed asset, subject to limitations. First of all, the interest capitalized is limited to the amount that is theoretically avoidable if expenditures for the self-constructed assets had not even been made. So what that means is, for example, if the entity had not self-constructed an asset, those funds might have been used to basically to repay debts. Another limitation is interest capitalized may not exceed the actual total of interest incurred during the period. Now we're going to go on and talk about the capitalization of interest calculations, and this information in the description in these boxes will become, I think, a little bit easier to understand as we go through an example. Anyhow, capitalized interest, the amount that can be capitalized, equals the weighted average of the accumulated expenditures for the capitalization period times the relevant debt. Now, the relevant debt we can express in terms of our interest rates. And basically it's saying is if specific new borrowings during the capitalization period can be identified with the self-constructed asset itself. In other words, we borrowed money explicitly for that asset. Okay, the rate on the obligation should be applied to the extent the average accumulated expenditures do not exceed the amount borrowed. Also, to the extent average accumulated expenditures exceed the amount of specific new borrowings. In other words, basically we've exceeded that specific new borrowing for that debt. We can include then a weighted average rate must be applied that is based upon other non-specific borrowings during the period. So if the accumulated expenditures exceed that specific borrowing, we look to other debt that was issued during that period and basically imply that some of that debt, in whole or part, also help finance that self-constructed asset. Now let's review an example of capitalization of a interest on a self-constructed asset. We have an example here where a company constructed a building for its own use, and that's important because if we're constructing it for somebody else, these rules, the capitalization of interest rules, do not apply. Now, on January 2nd, the company specifically borrowed, very important, specifically borrowed $1 million at the rate of 10% to finance the construction. Other general borrowings during the construction period, so other general borrowings during the construction period consisted of a $2 million loan, and that $2 million loan bore an 8% interest rate, and a $6 million loan which bore a 9% interest rate. Interest is paid at the end of the year for all of the above debt to make our calculations a bit simpler. Okay, let's first take a look at this, what I call the accumulated expenditure chart, or over here, the weighted average accumulated expenditures, or AAE. So we're taking a look at this by quarters, and we're also starting out with basically January the 1st. We also have our self-constructed cost during the period, the weighting of those costs, and then the weighted average accumulated expenditures for the period. So if we take a look at January 1st, we spent basically $500,000 of self-construction costs. Now, remember, that is the first of the year. So what that means is that out in that first part of the year, those construction costs were out there for the 12 months remaining over the 12 months. So that's basically, we would include in the weighted average 100% of those construction costs. As of April 1st, we had another $400,000 worth of accumulated construction cost. Now those construction costs are going to be for the months remaining May all the way through December. So it's going to be 9 divided by 12 times 400,000. So the weighted average accumulated expenditures for that quarter would be $300,000. Then in July, we had $600,000 of construction cost. And again, that would be for a half a year, 6 months. 6 months remaining out of the total 12 months, which means that's 50%. So 600,000 times a 50% gives us weighted average accumulated expenditures for July the 1st of $300,000. Now we go on to October the 1st. In this case, we had $400,000 of self-construction cost, and we have 3 months remaining, October, November, December. So it's 3 months divided by 12 months, and that's basically 400,000 times 3/12, or 1/4, equals $100,000 average accumulated expenditures, or AAE. And then on 12/31, we had $900,000 worth of expenditures at the end of that quarter. And in this case, there are 0 months remaining. So in this case, they do not enter into the weighted average accumulated expenditure calculation. So you take a look at our self-construction cost over the year, and our self-construction cost amounted to $2,800,000. But then when we weight it by the months that those construction costs were in effect outstanding, we get a slightly different number here. When we add up the weighted accumulated expenditures, the AAE, our weighted average accumulated expenditures come out to $1,200,000. So remember, we're going to calculate our interest rate or our capitalized interest based upon the weighted average accumulated expenditures, not the total construction cost, but the weighted average. So now we take the average accumulated expenditures for the self-construction cost, which happen to be $1,200,000. Now the question is what interest rate do we assign to that? Because if we take a look at the top, and let me switch my pen color here to differentiate this information a little. We take a look at the top. We borrowed money, $1 million at 10%. We borrowed another amount, $2 million at 8% and $6 million at 9%. So we're all kind of, I wouldn't say we're all over the place, but we have all these different interest rates. So how do we actually calculate this? Right now I'm going to leave the, because it'll take me time to go back to the red pen. I'll just stay with this yellow pen. So we have our average accumulated expenditures of $1,200,000. Okay, the first thing we do, if you remember from our previous pages, we apply any debt that we've incurred as a direct result of the construction itself. In other words, in this case, we specifically borrowed $1 million at a rate of 10% to finance the construction. So in this case, then, we take the $1 million that we use to finance the construction times the 10% rate. So that represents $100,000 to be capitalized due to the $1 million borrowed on that debt. Now, we take the $1,200,000, which was our weighted average expenditures. We subtract out the $1 million. And we end up with the remainder of basically weighted average accumulated expenditures of $200,000. Now what we do is we're going to multiply that times the weighted average of the amount of other borrowings during the period. And this included our 8% loan, our 8% loan. Let's see, I'll use another color now just to differentiate it. Our 8% loan and our 9% loan, these two additional loans. But again, which loan do I use? Well, I'm going to use, in this case, the weighted average of the two loans. Let me go back to the yellow crayon now, or yellow pen. So I calculate it this way. The amount I borrowed during that period was $2 million at 8%. That means my annual interest rate being paid at the end of the year is going to be $160,000, and my $6 million loan at 9%, and that'd be $540,000 of interest, again, annual interest paid at the end. So I take that, and what I have now is in theory, I have $700,000 worth of combined interest divided by $8 million worth of debt. So my weighted interest rate in this case would be $700,000 weighted interest divided by my $8 million, in effect, weighted debt. That means my weighted interest rate is 8.75%. So I take the remaining $200,000 worth of debt, I multiply it times the 8.75% weighted average rate, and in this case, I come up to $17,500. So the total interest to be capitalized during this period would be $117,500. And the journal entry would generally be, I'm going to take my interest and I'm going to when I pay my interest, I'm going to credit cash and debit interest expense. So what I would do is at the end of the year, I would credit interest expense for the $117,500 and then debit that to my self-constructed asset. Okay, let's take a look at question number 1. A company is constructing an asset for its own use. Construction began in year 5. The asset is being financed entirely with a specific new borrowing. Construction expenditures were recorded in year 5 and year 6 at the end of each quarter. The total amount of interest costs capitalized in year 6 should be calculated by applying the interest rate on the borrowing to the, you have 4 choices to choose from. And again, this is a good example of a situation where they're not asking you to actually do the calculation, but they're asking you to be able to describe what you would do theoretically. So again, we have our 4 choices. Go ahead and stop your video, and then when you're ready, restart the video and review the answer to question number 1. Okay, we're asking this question. The total amount of interest costs capitalized in year 6 should be calculated by applying the interest rate on the borrowing to, and in this case, the answer is the average accumulated expenditures for the asset in years 5 and 6. And the answer here again is capitalized interest basically equals the weighted average of accumulated expenditures for the capitalization period times the relevant debt interest rates. Okay, let's go on and try number 2. Okay, number 2. Spruce Company started construction of a new office building on January the 1st, year 1, and moved into the completed complex on July 1st of year 2. Of the building's $2.5 million cost, $2 million of that cost was incurred evenly throughout year 1. The company borrowed $3 million during year 1 at an interest rate of 8%. The total amount of interest incurred by the company during year 1 was $102,000. What is the amount of the average accumulated expenditures for year number 1? And again, remember, one of the key things here is that the $2 million was incurred evenly throughout year 1. So what would be the answer in this particular case? When you go ahead, stop your video. When you're ready, restart the video and review your answer. Okay, in this case, the question was, what is the amount of the average accumulated expenditures for year 1? And the answer in this case is B, $1 million. In other words, half of the $2 million, because we basically purchased it evenly throughout the year and made the expenditures. So accumulated average expenditures started out at 0 at the beginning of the year, and they ended up at $2 million at the end of the year. Therefore, without any really additional information, the simple average of the costs that are accumulated evenly through the year is going to be $2 million divided by 2 equals $1 million. Okay, we have Spruce Company again, and Spruce Company started construction of a new office building on the first of the year, then we're going to see pretty much the same information as before in number 2. So we started construction on the first of the year of year 1 and moved into the completed office complex in July, year and a half later, July 1st, year 2. Of the building's $2.5 million cost, $2 million was incurred evenly throughout year 1. That's the answer basically for question number 2. The company borrowed $3 million during year 1 at an interest rate of 8%, and the total amount of interest incurred by the company during year 1 was $102,000. So now the question is that what amount should Spruce report as capitalized interest at the end of year 1? And again, you're given your 4 choices. Stop the video, do whatever computation you need to do, and then restart the video when you are ready. Okay, in this case, the question again was, what amount should Spruce report as capitalized interest at the end of year 1? And the answer in this case is $102,000. Most of the students that I have typically will do the computation. They'll take the $3 million. That's the amount that I borrowed. And the amount of interest that I'm going to have to pay should be somewhere in the area of $240,000, 3 million times my 8%. So the amount that I would think I would be the amount that I would think would be around 240,000. There is that answer there on the slide. But what you have to remember is one of the rules of capitalization of interest is that capitalized interest cannot exceed the actual amount of the interest paid during the period. So the amount of the interest paid during the period was $102,000. Again, everybody's concerned about complex calculations with the this capitalization of interest, but so far the first 3 questions really didn't count on complicated calculations. It's basically testing, do you know the rules? Okay, another question now. In this case, again, this is a question, nothing in terms of complex calculations, but it's asking, do you know the rules? During the year, Indiana Board Games constructed machinery for its own use. And it also constructed machinery to be sold to customers. Bank loans financed all the construction costs during the period of construction. How should interest be reported on the financial statement? So this is a really good theoretical question. Okay, and we have our 4 choices. Go ahead, review your choices, make your choice. Stop. Don't forget to stop your video, and when you're ready, restart your video for the answer to number 4. Okay, and the answer to number 4 is basically, again, how should interest, the question is, how should interest be reported on the financial statements? And we have 2 types of machinery construction, for our own use and for machinery sold to customers. And the answer in this case is C. And what it says is the interest is capitalized for the machinery for our own use, like we talked about, and the interest for basically making machines held for sale, in effect, our resale inventory, is basically expensed. We talked about that early on in our in the presentation. Okay, number 5, Defender Inc. began constructing a building for its own use in year number 5. During that year, Defender incurred $50,000 of interest on debt specifically for the construction. Interest computed on the weighted average accumulated expenditures for the building during year 5 was $40,000. What amount of interest should the Defender capitalize for the construction? So again, look at the answers, stop the video, check your answers, come up with an answer. When you're ready, restart your video. And here is the answer to question number 5. And again, the question is, what amount of interest should defender capitalize for construction? And in this case, the answer is B, $40,000, because that was the interest computed on the weighted average of accumulated expenditures for the year of $40,000. We wouldn't use the full $50,000 because we're only calculating our capitalized interest cost on the weighted average of accumulated expenditures. And with that, that is the end to our brief discussion on self-constructed assets.